Wall Street analysts are doing something right now that almost never happens before earnings season. They're raising their forecasts instead of lowering them. History says that's not good news. In fact, it's one of the clearest warning signs the market gives us. And this earnings season, that warning is flashing at the exact same time the S&P 500 is sitting near all-time highs. Welcome back to Wealth Signal. Quick reminder before we dive in, everything here is for education only, not financial advice, so always do your own research. Today I'm breaking down the one signal from this earnings season that most investors are completely missing, and why it could decide whether your portfolio goes up or down over the next 6 weeks. Here's the pattern that matters. Normally, heading into earnings season, analysts lower their estimates. That gives companies room to beat expectations, and beats tend to fuel rallies. That's exactly what happened back in April, when the market climbed roughly 9% during earnings season. But this time, analysts have been raising estimates instead, and that flips the odds against us. Why does that matter? Because when expectations are already sky high, even genuinely strong earnings can trigger a sell the news reaction. The economy right now is strong, really strong. But strong economic data doesn't automatically mean a strong market reaction. In fact, this combination, high expectations plus a red-hot economy, is historically more likely to produce a net negative earnings season than a positive one. Big tech isn't one group anymore. It's splitting into two. On one side, you've got the legacy giants, Microsoft, Apple, Amazon, and Google, the hyperscalers pouring hundreds of billions of dollars into data centers. On the other side, you've got the AI infrastructure and chip stocks. And right now, only two of the legacy megacaps are showing a genuinely bullish, fundamental, and technical picture: Apple and Meta. Everyone else in that group is telling a different story. Tesla is carrying a bearish rating right now. Oracle just made a fresh 52-week low. And Nvidia, despite being the most talked-about stock on the planet, isn't showing much underlying strength going into this earnings season. This is a highly selective market at the very top of the market cap chart, and treating all of big tech as one trade is a mistake. Let's talk about Oracle, because this is the clearest cautionary tale of the season. Oracle made a massive $300 billion bet, building out data center capacity to sell to OpenAI. That bet only works if OpenAI's growth story stays on track. But OpenAI just pushed its potential IPO from 2026 to 2027, reportedly because the company is losing money and chasing a $1 trillion valuation it may not get. That single delay puts Oracle's entire growth thesis on shakier ground. The stock has fallen from roughly $240 down to a new 52-week low. Some analysts are calling this a buy-the-dip opportunity. I'd push back on that. This isn't a dip. It's what traders sometimes call catching a falling knife. Until Oracle proves its AI infrastructure bet is paying off, I'm staying away from this name. Now, here's Nvidia, the poster child for sell the news. Look at its last 4 earnings reports. Every single one beat expectations. And every single time the stock sold off anyway, typically somewhere between 5% and 10% in the days that followed. The hype and build-up happen before the report, and by the time the news actually lands, there's often nobody left to buy. Nvidia made its high back in May, above $230, and has since traded as low as $190. Right now, it's struggling to reclaim the $210 level. If it can't break back above that resistance before this earnings report, it walks into earnings in a technically weak position, and based on the last 4 quarters, that's exactly the setup where a sell the news reaction becomes more likely, not less. Here's where the story flips completely. Micron, AMD, SanDisk, and Dell already reported their own earnings recently, and they blew out the numbers. But instead of rallying, these stocks fell 15 to 20% from their highs in the following weeks. That's not a red flag. That's a name for something specific. A short-term, oversold bounce setting up. All four of these stocks are currently showing bullish underlying ratings, meaning the fundamental and technical picture is still strong. The pullback is sentiment-driven, not fundamentals-driven. This is the opposite dynamic from Nvidia and Oracle. Instead of high expectations creating a sell-the-news risk, these names already got their bad reaction out of the way, and now they're sitting at prices that look genuinely buyable. This is also where small and mid-cap stocks come in, and why they behave completely differently during earnings season. These companies aren't followed by dozens of analysts the way Nvidia is. So when one of them reports a great quarter, new analyst coverage tends to follow. And that pulls in new buyers who weren't paying attention before. That's the exact opposite of the nobody left to buy problem. Take Avnet, ticker AVT, a roughly $6 billion electronic components company most viewers have probably never heard of. After its April earnings report, the stock ran from around $77 up to $94 over the following 2 months. It's currently carrying a bullish rating and has only pulled back about 10%, compared to 20% for some of the bigger names. That kind of under-the-radar name is where earnings season follow-through tends to live. Zoom out to the calendar for a second. Mid-July through mid-October is historically one of the weaker seasonal windows for stocks, and this earnings season sits right at the start of it. That doesn't mean a crash. It means choppier, more volatile price action over the next 4 to 6 weeks, with the possibility of some spillover weakness into September. If that weakness does show up, the pattern from past cycles suggests it could set up a strong buying opportunity heading into next year. So the next few weeks matter less as a moment to panic and more as a moment to watch closely, because how these earnings reports get received will tell us a lot about where the next few months are headed. So let's rank what actually matters here, starting with the weakest signal. Number 3. Mega cap tech as a group. This is where I'd be the most cautious. High expectations, a name like Oracle facing real questions about its biggest bet, and Nvidia needing to prove it can finally beat the sell the news pattern. This is not the place to chase strength right now. Number 2. The oversold chip names, Micron, AMD, SanDisk, and Dell. These already took their earnings season hit, and the underlying picture is still bullish. This is a genuine buy-the-dip setup, not a falling knife, because the pullback happened on sentiment, not on the fundamentals actually breaking down. And number 1. The strongest signal this earnings season. Small and mid-cap names that are still underfollowed by Wall Street. Stocks like Avnet show exactly why good earnings tend to keep working in this part of the market, instead of getting sold immediately. If you're only watching the mega caps this earnings season, you're missing where the real opportunity is sitting. If breakdowns like this help you make sense of earnings season, hit subscribe so you don't miss what happens next, as these reports keep rolling in over the next few weeks. And drop a comment telling me which stock from today's video you want me to dig into deeper next. Remember how we started. Analysts raising estimates right before earnings season, a pattern that's historically flipped the odds against the market. That paradox is exactly why this earnings season needs a selective approach, not a blanket one. Some names deserve caution, others deserve a much closer look. Stay sharp out there, and I'll see you in the next video.